Hello, everyone. Welcome to another episode of Macro Matters for the CFA Society of Chicago. My name is Rich Excell, member of the CFA Society of Chicago, and I'm once again joined by my colleague at U of I and CFA Society, Tony Zhang. Tony, good to see you again.
Hi, Rich. Good to see you. Again, definitely over the past few weeks, when we were absent, the market actually went through the roller coaster. Okay, going going downhill and then coming back up. I guess a lot of investors would want to like how market is going forward. I think this is it's a good time for us to actually come and maybe discuss and share our thoughts together.
Yeah, for sure. I mean, for some things you look at them and like the prices don't look any different. We round tripped on the 10-year treasury yield, we round tripped on the VIX, et cetera, but there's probably some more permanent damage done underneath all that surface. So you're absolutely right. It's good to talk about it because we had a pretty ugly Monday, August 5th, and then markets kind of bounced back, and some might be feeling that everything's fine, but I don't
Yeah.
know if, as I've been kind of writing about on Substack and LinkedIn, I'm not so sure that we've got the all clear for risk taking again. But maybe I don't know what I mean. I was going to start by, a lot of people are talking about what's going on with the yen carry. Is this the yen carry trade? Was it Fed mistake, BOJ mistake? What's really going on? I'll start by giving my 2 cents of what I think happened, and then let's see what your thoughts are. And I think it's important to understand what happened because that can tell us when it's going to stop happening. And
Oh,
so
definitely.
if we look at it for the last 2 years, really, maybe even longer than that, probably longer than that, Japan has had close to zero interest rates. Not only that, but they've had a central bank that has been the most dovish in the world. When every other central bank was hiking rates to try to get rid of inflation, Japan was keeping their rates as low as possible, in some ways trying to import inflation because they've had multiple decades of uh, deflation. And so what was happening was not only did you have low interest rates, but you had a currency that was weakening. And this is important to understand because now let's think about levered investors. And so when I worked at a hedge fund, you're trying to find and borrow at the cheapest levels you can in order to use that leverage and invest it wisely to basically turn a profit. And whether you're a global hedge fund or a small hedge fund here in the US, there's a really good chance you were borrowing in Japan at zero interest rates because the only risk to you was that the yen would strengthen. But as we said before, the yen was weakening. And so, um, you know, you're borrowing at zero interest rates. You're having to pay back in a currency that's weakening. Nothing could be wrong, right? You're able
All
to
right.
turn around and invest that in just about any strategy. You can invest that in equity long short. You can invest that in long only equity, AI chips. You can invest in crypto. You can invest in any possible strategy you want. And because your cost of funds was so low, this strategy returns looked very, very attractive. But like I said, the biggest risk of that is if the yen starts to strengthen. And when the yen started to strengthen, and it started to strengthen well before we had a BOJ meeting and a Fed meeting, it was already starting to, the market was starting to price in both Japan and the US, a narrowing of that um, Treasury versus JGB yield. So we were
Mhm.
starting to see that. So we started to see a little bit of risk unwind. And then we had the combination of both the BOJ being more hawkish than expected, raising rates 15 basis points when I think it was only 5 or 10 was expected. And then we had the Fed come out in what many think was more dovish than expected. Again, we can talk about that. I'm not so sure
Yeah.
myself, but that collapse, and all of a sudden the dollar yen, which had weakened all the way up to levels above 160, and we've talked about that before and the importance of that, collapsed down to 140 handle, and this caused a lot of hedge funds to have to take risk off. And the other
All
thing
right.
to understand, I think, in the context of all of that, is that how money is allocated on Wall Street, especially among the big multi-strategy hedge fund platforms. It's it's allocated using value at risk. So essentially, volatility is an input. When volatility, so people, you're allocating a component of risk or dollars at risk. You're not allocating capital, and so you're allocating these dollars at risk. So as volatility goes lower, portfolios appear less risky because there's the assumption of what loss you could have in with 95% confidence over a 10-day period goes lower and lower as volatility goes lower and lower. When volatility spikes, those loss levels look much higher. And so funds have to de-risk to bring their book size, if you will, down below that VAR threshold. And then, of course, you have other money allocated, like volatility targeting funds, risk parity funds, et cetera. So as volatility is going up and it spiked up to 65 on August 5th, there are just many mechanical processes where people need to take that risk off. And they're not taking any view one way or the other. They're not expressing the view on recession. They're not expressing a view on interest rates. They just essentially are being told by the risk managers, you have to reduce your risk. So
Yeah.
that's kind of how I saw things play out. And I think it's important to kind of see that context. But I don't know if you had any thoughts on what we saw in the last couple of weeks here.
Yeah, Rich, I agree with most of what you just say. Actually, during the periods, like in panic period, like no matter what kind of investment style of a portfolio managers are, they actually tend to de-risk their portfolio. When we are talking about de-risking, is meaning that they don't actually think about the fundamental, just basically just push the sell button and then sell everything. So in the traditional environments, like even in the traditional finance, when people actually claim that maybe some goal, and for instance, like the treasury bond have having low correlations with the return of the stock market, especially in the panic situation when in recession, and we tend to people would investor would actually thought that capital actually will flow out to heaven, which means that over the past 2 weeks, we should expect to see that the capital flow out to either treasury yield or either flow to the gold. But that wasn't the case. That actually was telling us is like the risking process was the dominant factors over the market. So basically, they don't even think about this like a correlation. They just literally want to actually sell everything when the volatility spike. And I agree with what you're just saying that over the past, I think last week, especially literally last week, when we saw the VIX index spike over 35 and reach above like almost like somewhere the low 60, which we haven't really seen for almost like a four years. It's like I think in the COVID period time, and that actually was telling us that in when the VIX spike and the lot of hedge funds, macro fund, institution, basically was in a panic mode. So they sold everything. And now what happened later last week, then the market actually was come back up and think that Federal Reserve might actually step in and have some kind of a special meeting. You know, we saw some like a rumor to say the Federal Reserve might actually call for an emergency meeting, which will never be the case, is that they're going to actually step in and cut interest rate. And even at this moment, I think that we are going to maybe touch base later today that the market still perceive the Federal Reserve actually would cut interest rate in this September meeting, at least like 25 basis point, or even like more aggressive, like 50 basis point, right? This is so
Yeah.
this is not continue to perceive this, but both of us was actually quite pessimistic about the trend or the path the Federal Reserve would take over the rate cut, even starting from the beginning of this year, right? But
Yeah.
market continued to perceive, oh, actually, if something happened, that actually Federal Reserve central bank might just come in and cut interest rate. Apparently, apparently, there are rooms actually for central bank to taking some kind of action, but as what we believe that most likely central bank would not actually take any stance like before the presidential election. If this year is like outside the presidential election year, that probably they will. But this year is kind of a special. I think unless something really like dangerous like happen, that central bank most likely would actually disappoint the market expectation.
Yeah, and then they'll have a chance at the Jackson Hole meeting at the end of August here in a few weeks to kind of talk to the market again. But I think you're absolutely right. I mean, the people calling for an emergency cut, I don't think they must not have ever lived through any other market crisis that's gone on in the last 30 years, because that
Right.
wasn't a crisis. That was a one-day volatility event. That was
Yeah.
far from a crisis. And the Fed does not, contrary to popular belief, the Fed does not care about equity prices. They don't care
Correct.
about equity prices if it's being caused by multiple contraction. They care if stocks are being sold because earnings expectations are collapsing because economic views are collapsing. The
Correct.
Fed cares about that. And so you have to understand the root cause of why the market's going lower. And I think one other point before we kind of move on and maybe look at some charts here is that this is also the world that we're going to be living in now going forward, because passive money dominates the flows into the market on a daily basis. And the
Hmm.
thing we have to understand about passive money is by definition in the passive, there's no thought being put into this. When the money comes in, it'll buy the index or the ETF, and when the money goes out, it'll sell the index or ETF. There's no determination or thought as to whether or not that's expensive or cheap, unless the end investor moving the money into those vehicles is considering that. And we know a lot of that money is not considering that, because a lot of it is coming in via 401k defined contribution types of plans where it's just on a routine basis coming into the market. And that what happens then in these market crisis events is there's just no liquidity. And so when hedge funds have to sell and there's no one there to buy, moves are just much larger than they ever otherwise would be. So
Correct.
as much as we have criticized active fund managers, the one thing about active fund managers through the years is that they tend to be more mean reverting. When things are expensive, they sell it, and when things are cheap, they buy it. That's just not the case when we're looking at a market dominated by passive structure, which tends to have a more momentum component to it. But
Correct.
maybe on that note, I'll start by sharing the factors to watch screen on Bloomberg. And for those that are listening, well, we'll try to talk you through what we're seeing. For those that are on YouTube, you'll be able to see this, but we're going to start by looking at one of our favorite screens, which is the factors to watch. And I'm looking at the sector neutralized version of this for a long only fund, if you will. And the two things we noticed in the last week is what have been the biggest movers over the last week. Um, Momentum still a very strong mover, believe it or not. And growth is still a very strong mover, whereas value and dividend yield here are among the worst performers. And you can see a lot of this is because of maybe the 1 day return on some of those things. But as we've talked about before, Tony, like value versus growth is really kind of comes down to when the market's worried about growth, it actually moves into growth stocks because they favor stocks that are able to show growth in a low growth environment. And when
Hmm.
the market is becoming less worried about inflation, that's when they sell value, because value debt benefits from inflation. So I look at that and I think to myself that the market is lowering its expectations of growth and lowering its expectations of value, which is consistent with what we're seeing in the interest rate market in terms of pricing and more Fed rates. But you're more the expert on this factor analysis. So what do you think we see here?
Yes. Richard, this is a very important, actually, the screenshot that I like when actually evaluating how market perceive the risk level internally, and factors actually show basically a lot of the symptoms or symbolic actions like inside the market. Like from what we just saw here, as you pointed out, momentum factor by itself is still the most like a dominant factor for year to date, as we continue to see, there's like this is a large contribution or contributing factors over the movement of the market. And no surprisingly that people can continue to anticipate it. Still, instead of a Magnificent Seven, now we are looking at the Magnificent like a FAM only five stock instead of like seven stock. So those stocks actually are driving the performance of overall market. That's why it dominant, especially in the high interest rate environments at this moment. Like what people actually are looking for, um, actually some investment vehicle that actually can compensate for their like additional risk in addition to the risk-free rate, right? The risk-free rate right now, without being caught, is still like a 5.25%, which is
Yep.
much higher than the typical like a dividend stock, which actually offer like a dividend yield like 3.5%. So that's why we actually see that dividend stock and some value stock not a preferred like a styles over the market at the moment. But given the situation that the Federal Reserve might actually cut the interest rate in the September, so the value stock and dividend stock D has actually a nice bounce back over the past 2 weeks during the market sell-off. It actually hold up very nicely relative to the growth stock, which actually also happen to be the momentum stock. And now, if we actually look at most of the things, especially like what might be the things going forward. At the beginning of this year, we saw the largest divergence between the value and growth. Over the past couple of weeks, we started to see the contraction of such divergence, like which means the momentum got some sell off, and then dividend and value stock got more of a acquisition just for the risk off position. So here, like going forward, apparently Federal Reserve might have to actually cut interest rate once as we approach to the end of this year. Then the cycle of federal easing cycle might stop. That might be the moment that we might start to see the divergence between the growth and value might continue to contrast. So that might be some general expectation. But this year is kind of a special. What the special really means, there are a lot of the things actually going on here. So in addition to the general like economy, apparently the U.S. still has a very resilient economy, even though the um, unemployment job data reports like in prior week tend to actually show we do have some kind of weakness in the employment, which actually you pointed out that Federal Reserve does not care about the stock price, but they do care about the earning, especially the earning growth.
Yeah.
Because by definition, or by the memo, the mandates that one of the two mandates for Federal Reserve is actually to continue to maintain or to reassure the employment rate within the U.S., which actually would help to basically consolidate the earning growth for the public trading company. So we, from that being saying that even though the U.S. still sees some strong economy, which actually leading to a strong earning growth perspective for the stock here. But if we look at internationally, what would happen? Like if we look at Europe, look at Canada, and most of the places are continue actually to cut the interest rate, lower the interest rate by the central banks over there, with actually very pessimistic like earning growth economy situation over there. And there are still some geopolitical risk, like especially we all know about the tension or the war between right now the Russia and Ukraine, what might actually intensify. Um, what if like Middle East add another like ingredients over here that we could continue to see the disturbing effect over the maybe the recovery or continuous growth of the international economy. So we do see some geopolitical risk continue adding over here. Other than the maybe the internals like the slowing down of the U.S. economy, because due to the high inflation rate, the inflation hasn't really slowed down, but it did maybe slightly, but there are still way to go before we actually really see the inflation going down below maybe even close to 2%. I think the latest data suggests, even though it's slowed down, but it's still far away from the central bank's expectation. Maybe from now on, the general expectation is we might have to live with like a high inflation rate here around 3%, not higher, not lower. So that's how I interpret that, Rich.
Yeah, no, I mean, when you talk about inflation, you mentioned some things that are impacting commodity markets, and I want to look there. The only reason, one of the reasons I really wanted to kind of focus on this, on what's happened over the last week as well, and unfortunately on Bloomberg, you can only see 1 week and year to date. You can't really see anything in between there. Is that I think that what we saw on Thursday and Friday, whatever was August 2nd, 1st and 2nd, and then Monday, August 5th, was the hedge funds de-risking. And
Yes.
then after that, they weren't around. They don't go right back to the market. Typically, they're done for the month. If you get stopped out of your positions as a hedge fund, you're done for the month. So you don't go back into the market. And so then the drift that we've seen back higher is money that's coming into the passive vehicles. And the money
Correct.
that's coming in the passive vehicles is going into exactly the same things that you're talking about before, the momentum and the growth. But
Correct.
you also mentioned some things about the commodities, right? You mentioned Russia-Ukraine war that's going on, and that we have seen a bit of an escalation there, right? Ukraine's actually invaded Russia. They've gone into
Mhm.
Russian territory. At the same time, Russia's
Correct.
further than Ukrainian territory. Very interesting dynamics there. That clearly looks like an escalation. We know the fighting in that area stops when the weather starts to get really cold
Yes.
in November or so. So this seems to be a bit of a last push on both fronts before the fighting is going to stop in a few months. So
Agree.
that does look very much like an escalation, as you said. Today, as we sit here on August 12th, there's all sorts of rumors that Iran is going to retaliate against Israel. Now, the last time Iran retaliated against Israel is a very well telegraphed strike that Israel was able to interpret. We'll see if it's the case this time. But as you can see, crude oil here on this screen, we're looking at the global commodity screen. Crude oil is getting back up to $80 a barrel, and Brent
Yes.
crude is above $80 a barrel. And so there's more and more, we're seeing Henry Hub nat gas back above $2. It crept below there. There's still some commodity markets that are under siege. If we look at corn and soybeans, et cetera, have had a really, really tough summer as the yield estimates are going higher and higher. The export numbers are coming lower. And so those food markets, if you will, are struggling. Live cattle prices have stayed really high. So it's
Mhm.
not like there's a huge relief to the consumer on all food aspects.
Right.
But the most important number that people look at, of course, is oil and gas because that's the number most people are well aware of, and we can see
Yes.
that gasoline and crude oil are creeping back up to some of the highest levels we've seen in some time because of what's going on in the Middle East, what's going on in Russia, Ukraine, and
Correct.
one thing that we can't forget about is what's going on in Venezuela, where there
Yes.
are elections, and there's riots because the party in charge is not adhering to the election results and is shooting at its own people. And we can't forget that Venezuela also exports a lot of oil. And so some of the main oil producing regions are all seeing these geopolitical flares. And while we're conditioned to fade the news on these geopolitical events in some of the markets, it's uncommon to see these major risk flares going on in three major oil producing regions all at the same time. And
Hmm.
so I think you can see by a relatively muted but positive reaction in the oil market, I think people will say, hey, if any one of these things really kicks off, oil could go higher. We saw in the Brent crude market 2 weeks ago, um, traders were buying November 110 and 130, 110, 130 call spreads. So that's like, 30% out of the money just as a way to hedge because Europe is very, very reliant on Brent crude as a source of how they heat their homes into the winter. So that's a risk that if supply is disrupted and Brent crude is the main global supply, not the WTI that we care about here in the US, that's something that could really cause again this inflation. When we saw crude prices and gas prices spike before, we saw big inflationary impulse. We know it's going to lead to upward pressure on wages. You mentioned the jobs market is weakening, but people need to be able to afford to get to and from work. And so, especially as we head into an election season here in the US, I think you hit on the head. Geopolitics, which are always either negative or a non-event, certainly seem to be where there's a lot of potential catalysts for some negative price moves, which means typically higher commodities, oil and gold, and lower risky assets or lower stock prices.
Yeah, Rich, definitely. When we actually talking about the inflation and due to the hiking price of the commodity, this is a developing concerns for me because from what I have saw, this really remind me about the periods in 2007 and 1998, and when um we saw the high inflation in the U.S. economy, and everyone know what happened right after that in 2008 and 1998. So this is actually quite concerning to me. Here we look at one of the reasons that Federal Reserve hasn't really cut interest rate is simply because we have a very strong labor market in the U.S. But over the past 2 months, what we continue to see, even though we continue to see the higher maybe employment data, but we continue also see the high unemployment data, right? Unemployment rate has actually hiked around like 4.1%, but we continue to see the increasing number of non-farm payroll. So if we actually try to interpret this paradox, the only explanation that people can actually get will be here. Some people got laid off, apparently. Then people have to find some maybe part-time job, like doing as an Uber driver or as Lyft or maybe Uber Eats driver, and do some kind of a maybe more of a part-time work that can actually help to the increasing number of the non-farm payroll. So that's just so the scenario is actually telling us many public companies are actually taking some more of the action to actually delay or let people, the normal, the what we typically call the middle class people actually off their job, and simultaneously those people have to actually find some maybe lower hourly rate job to actually to feed their family or their actually normal expense. So that's actually what's really happening over here. But that means there's a lot of the expense will become unsustainable going forward, especially what we have seen. We continue to see the higher defaulting rate over the credit card, and we continue to see the high default rate over the people's like mortgage, right?
Yeah.
That have been become very concerning to me. And we, even though we continue to see the market continue house here, but it's more of speculation that Federal Reserve might have to cut interest rate more aggressively than market anticipated. Now here, maybe as by yesterday or maybe by noon today, market would perceive that Federal Reserve might cut 50 basis points in September and might continue to have to cut maybe 50 basis point or even 1% or another by the end of this year. So that's how people would do speculate it. So all of the market's behavior right now are really like a speculative than the fundamental to me. So this is what concerns me. I think this is might be the moment for a lot of institutional investors to really think through what kind of risk for their portfolio and whether their portfolio are well diversified in terms of a risk management perspective.
Yeah, great points on all that, Tony. And I mean, and this, there's the SOM rule, which says when the 3-month moving average of unemployment rate moves
Yeah.
above the lowest threshold that it had seen, when that's 0.5 or higher, we've always had a recession. That triggered in the last unemployment report. Of course,
Correct.
Claudia Sahm, who invented the rule, has come out and said, "Oh, it might be this different this time," and some people are trying to debunk it, but forgetting about the non-farm payrolls, which has been revised down every month for the last 18 months. So I
Exactly.
get a little question about the credibility of that number, but look at all the other labor market indicators. Look at continuing jobless claims. The initial claims number gets all noisy with the weather and hurricanes, et cetera. The continuing claims, the people that continue to file jobless claims, has been going higher and higher and higher. The percentage of unemployed has gone up by 20% from the lows. You look at the ISM employment data is in recession territory. You look at the National Federation of Independent Businesses, or small businesses hiring plans, is at recession territories. There's lots of other labor indicators that telling us that things are not looking particularly good. And talking about those consumers, as you mentioned, credit card delinquencies, the percentage of individuals who are 90 days plus delinquent on their credit cards
Correct.
is again at recession territories. And the ones that are most delinquent are the 18 to 29-year-olds and the 30 to 39-year-olds. It's the younger workers. It's not older workers. And
Yes.
so those are the ones that typically tend to consume quite a bit too. And so the consumer is looking very, very stretched here. And I think that's something that we want to be wary of. And that's something that I'm sure the Fed's aware of as well. Because they do care about that employment.
Correct.
Along those lines, I wanted to say, 'cause, I mean, again, maybe that's the kind of the market that we're talking about. One of the other major movers on August 5th, or maybe it was August 4th, Sunday overnight before the market opened, when this was all unwinding on Thursday, Friday, and into the weekend, one of the most massive moves that we saw was in the crypto markets, right?
Yep.
Ethereum was down more than 20% at one point. Bitcoin was down more than 10%. They have kind of started to creep back up like we've seen in other markets. But we're still kind of well off the all-time highs. If I
Yes.
just looking at all the crypto, if I just bring up the chart of Ethereum here and look at it, we can see that I'll just do a quick Bloomer calculation. We can see that we are, at the lows, we are almost over 48% from
Yes.
off the highs of this year. And where we are right now, we're still down about 35% from the
Yes.
highs of this year. Um, I know that people in crypto tend to want to hodl. They don't want to ever sell, etc. The reality, though, is a lot of the people in Bitcoin and Ether now, the people that are going to be making decisions, not the ones that are never going to sell, are in the ETFs, and now they're underwater on their ETFs. That might lead to a different reaction function in crypto than we typically see. Is that something that, as someone who's followed the crypto markets for a long time, you think we might be seeing a changing nature, changing structure of the crypto markets?
Yes, certainly. From the crypto investment point of view, that cryptocurrency used to be viewed as maybe a risk, I think, diversified investment vehicle from retail investor and from institutional investor point of view due to their low correlation with the major equity market just before that. But since the introduction of both spot rate of Bitcoin ETF and later on the Ethereum's spot rate ETF, what we anticipate to see that might actually with more of liquidity going into the cryptocurrency, we should expect to see the lower return volatility of both major cryptocurrency. However, that's not the case, as what you just show here very typically. Now, Ethereum's just tumble like more than 20% overnight without any major news. There was even no major news other than a rumor that maybe the jump trading was liquidating their position. That was just a rumor. So this is no major news talking about here. So this is more of a some kind of a, I think, risky signal here than there are actually major institutions de-risking their position, as what we just mentioned about like 5 minutes ago. They want to cut their portfolios without even thinking through any consequence. They just want to sell, sell, sell. Okay, so that was actually what drive down the Ethereum's price and Bitcoin price significantly. But here, what we anticipated from the point of view from the both regulatory agency, SEC in this case, because the reason that SEC approved the spot rate of the Bitcoin ETF and Ethereum ETF is they might actually add additional investment vehicle for institution to actually diversify their portfolio, which means the lowering the risk of overall portfolio. But from what the reality, this now instead of lowering the risk, it actually increased the risk of the overall portfolio if institution de-add the cryptocurrency into their portfolio. The correlation turned out to be instead of a low, it turned out more of like Wall Street style of investment vehicle to me as from now on. So what we anticipated, what we expected to see is with like because right from the founding principle of the Bitcoin, it is like it's what a virtual currency that's against the printing policy. What is like the from central banks to printing the money, right? As they say, we are going to have a fixed amount of the the currency. So with more of the inflation going on, we should continue to see the high price of the Bitcoin. That because that's the funding principle, and it should be decentralized. Now we continue to see the erasing effect of the funding principle, two funding principle, decentralized, and it's against inflation. None of this like two funding principle work here. Now here it become raise a big question is what will be the position and what will be the role for the cryptocurrency for institutional investor and retail investor from their portfolio point of view.
Yeah, I mean, those are great points, Tony. I remember writing an article more than a year ago that said, be careful what you wish for. A lot of the people in the crypto market wanted to see more institutional investors coming into the market, wanted to see the adoption of ETFs, et cetera. My point then, my point now would be when institutional money comes into the crypto market, it's going to look at crypto very differently than those in the crypto market are going to look at it. It's going to be a sharp ratio world, right? You're going to look at the
Yes.
returns and risk of that asset relative to everything else in your portfolio. You're going to look at correlations and you're going to allocate accordingly. And that's what we saw in this recent episode is that crypto was just seen as another risky asset. And given the volatility we've seen, and now given some of the poor returns that we've seen, the Sharpe ratio probably is not looking particularly attractive relative to other assets. I mean, I've been on record for more than a year saying I preferred Ethereum to Nasdaq, but after this recent episode, it's hard to argue for Ethereum right now relative to Nasdaq because the Nasdaq actually held up quite a bit better. Now, I think one thing I'd say, I mean, we of course we don't know what any individual firms were doing, but back to the point before on why levered investors need to be so quick to reduce risk and really have to be objective about it and have to be unemotional about it is when you have to think that a lot of levered investors, they're leveraged 6, 7, 8, up to 9 times leverage. So let's say you're 8 times levered. If an asset moves more than 12%, your capital is completely wiped out. Therefore,
Yes.
you have to start acting well before 12% down, probably acting about when it's down by 1 or 2%, reducing your risk and all the way down because you're trying to conserve your capital. You're trying to hold on to your capital so you can continue to invest for another day. And so these big major moves like this, that is, if you come in and you're down that much on a Sunday night, you might be, facing an existential threat as a firm. Now, of course, there were maybe some other assets as well, but that's something where you have to understand that the reaction function of levered investors is very, very different than a long-only investor because of this leverage component, because of how your capital can get wiped out. It's one thing to say the market was down 20% and so I'm 20% poorer. It's another thing to say the market's down 20% and I no longer have any capital. That's a very, very different, very, very different
Yes.
story.
Yes.
I
Yeah.
wanted to
Actually.
look at one last chart before we leave here, and that's the U.S. 10-year yield, which again we talked about it last time we were on. I was on record saying I thought it was going to go much higher into the summer. I was completely wrong, and here we are. We hit a peak around 4.7% back in May. We broke below 4.2%, I think, last time, or right around 4.2% last time we talked on Macro Matters. And in the course of the last week or so, it fell to a low of 3.6%, and now it's back up to 3.9%, pretty much kind of flat week over week, if you will. Again, some people think that this is the investors factoring in a recession coming, and there might be some of that, but I think maybe more of what we're seeing going on is, again, this kind of flight to quality. When you're de-risking everything you can, money's going into cash. Where's that cash going to be parked? It's going to be parked somewhere on the treasury curve, and 10-year treasury is the most liquid part of that. 3.9%. If you had to wager over the next month or two, higher or lower from here, Tony, what would you say on the 10-year treasury yield?
Well, from my point of view, that I anticipated that the 10-year treasury yield might go lower, given the market perceiving the Federal Reserve might have to cut at least 25%, or maybe even more aggressively, like 50 basis point. This it will continue to go lower, which actually I think she makes some reasonable argument that this might be the case, because for many reasons and many worrying reasons that we actually just outlined over there, in from both unemployment data and inflation and economy, geopolitical tension. Now, more of all of this should favor some maybe more of a safe haven. They tend to be the 10-year treasury yield, most liquid vehicle over there against risk. So from investment point of view, institutional investment point of view, this might be most likely the scenario. But I actually maybe add one more things, add one more comment from what you actually just talk about the cryptocurrency. At the beginning of the years, like Rich, I think that you are correct to call that we are going to see a buy on rumor, sell on news for the Bitcoin spot rate ETF. Like a couple of episodes, you are right again to actually call it buy on rumor, sell on news for Ethereum's like spot ETF. So this is continue to show some very negative market response from here. This is not a definitely not a promising sign for the market going forward. So this actually would help some risk averse like investment vehicle like treasury bond, even some commodity, traditional commodity like gold. This is for instance from historical point of view.
Yeah, so I think as we look at the as we look at the I'm looking at just the S&P 500 E-mini futures, as we can see that we've broken down below some shorter term moving averages.
Yes.
The trend is still positive, but the big difference in mindset, I think, among people who are active in the markets on a daily basis is that this has kind of gone from a buy the dip market to a sell the rallies market, because
Correct.
especially in the short term it's broken down. I think there's an expectation we're going to test the 200-day moving average around 4,900 in the coming weeks here. And the all-time highs are probably going to be a little harder to get to until perhaps we start to see a very dovish liquidity backdrop. And along those lines, just kind of the last point we want to bring up, here we are on August 12th talking about what's going on in the markets. Just looking at the data, this is a very data intensive week that we have starting tomorrow on August 13th. We get the National Federation of Independent Business, Small Business Optimism. But then we get PPI, we get the MBA mortgage applications to see how the housing market's doing. Then we get CPI, we get Empire Manufacturing from the New York Fed, and we get the Philadelphia Fed Business Outlook, and we get, again, more data from jobless claims and continuing claims. Lots and lots of data going on between Tuesday, August 13th and Thursday, August 15th. You look at August 15th itself, we get NAHB housing market data, we get industrial production, building permits, housing starts on Friday. There's a ton of data. You'll get the University of Michigan data too. There's just an absolute ton of data that's coming out this week of August 12th. And I think this will be the week when people start to see whether we are in fact seeing a slowdown, perhaps a recession, and if the market's going to start pricing that in. I think last week was really a lot of just de-risking and deleveraging. This week will be telling to see, one, if we are seeing any sort of meaningful slowdown, if not a recession, and two, if the market's going to start to adjust to that. I don't think we've seen that yet. But I think if we're going to see it, we're probably going to see it this week. So this is one of those weeks where I think everyone wants to be on their toes and be aware of the news that's coming out every morning as they sit down. Any last thoughts from you, Tony?
Yes, definitely. As what history suggests that when we actually saw the VIX index spiking above like 35 and reaching to 60, most likely we actually come back up to the similar level again. It's like after a couple of weeks in history. Okay, that doesn't necessarily mean that we have to see this happen again, but if history just suggests us that the risk inside the market actually has not completely gone away. So it's very likely, given a lot of this kind of economic data coming forward, any disappointment over the market. So the market might perceive more of the risk than the benefit from the central bank to cutting interest rate from now on. So we, from investor point of view, should watch out the volatility like very closely. I think this is definitely a very important period or important moment to stay vigilant from your point of view, Rich.
I just put up that VIX chart as you talk
Yeah.
about, and we did see that spike and it's come back lower. When we've had
Yes.
these periods of spikes before, they usually are not a V-shaped bottom in the market or a V-shaped top in the VIX. Like you said, we're moving perhaps into a higher volatility regime, and so that's something
Exactly.
that I think people want to be aware of. And like you said, it's time for them to be careful and to stay vigilant. So,
Yes.
on that note, I think we'll end, and we'll try to get back to you in a couple weeks to recap the data that we've seen in the last week or so, and then recap the closing of earnings. Tony and I have school starting, so we have every incentive to try to get another podcast done before
Yeah,
school starts.
exactly, exactly. The school start. I hope that we are not going to see the market volatility again, but we should actually continue to stay vigilant, Rich.
Yeah, we definitely should. So thanks everyone for listening. Remember to like, share, and subscribe. You'll be seeing this on social media. Feel free to kind of share that along. Macro Matters is done by the CFA Society of Chicago, but it is not only for our members. It's open to everybody. We just want to try to educate everyone on what's driving on the macro that matters, what's driving the market. Thanks for joining us.
Yeah, thank you very much.